All right, so I'm going to go ahead and get started. Give me just a second. All right, so we're going to go ahead and get started. And first and foremost, going to start with the video of how money works. Let's try this again.
More than 5 billion people around the world continue to struggle with money and financial illiteracy.
The financial industry is not set up for you to be educated and know what's going on. The less you know, the more they make.
How bad is financial illiteracy? It's not taught in school, so people don't know this naturally.
Oh, you're right.
So you grow up not knowing anything about it.
More than 5 billion people around the world continue to struggle with money and financial illiteracy.
The financial industry is not set up for you to be educated and know what's going on. The less you know, the more they make.
How bad is financial illiteracy? It's not taught in school, so people don't know this naturally.
Oh, you're right.
So you grow up not knowing anything about it. You make a lot of mistakes along the way, and we're hoping to educate them and teach them how money really works so they can learn the cause and effect of all this.
And it doesn't have to be generational. Break that cycle.
We're on a crusade to eradicate financial literacy through learning how money really works. Everybody should have an opportunity to become educated.
How money works.
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 Start taking responsibility by learning how money works.
You have to know how money works.
How money works. Stop being a sucker.
Money means possibility. It means opportunity. It means freedom, things you've always wanted to do, dreams that you have. Money makes it possible.
Well, it is great to have you here with us today. My name is Michael Rayford. I'll be your financial educator for the next half an hour. I'd like to welcome you to the How Money Works Elements educational series taught today on StreamYard. So this is a course that's based on our groundbreaking How Money Works, Stop Being a Sucker book, now with over 500,000 copies in print. Awesome accomplishment and still growing. Hope that you guys are having a great Monday. So How Money Works is the first education book that, and you've heard me say this before, that anyone from age 10 to 100 can read. And also, speaking of number 100, the book has been featured on more than 100 prominent TV shows, including CNBC, CBS, ABC, and Fox. The How Money Works book has received a rare endorsement, and you heard me say this before, but from our on our platform, the Heartland Institute of Financial Education, they have reviewed it and referenced it all over the web, including popular online financial publications. Make it on CNBC. You can also follow How Money Works on Instagram for practical tips and also helpful resources. So if you haven't received a copy of the book yet, just let me know. When we get finished, I'll make sure to get a copy to you as well. Now, our class today is the third of the five elements titled Protection. Once you complete all 5 elements, you'll have the opportunity to earn a certificate of completion. That will be signed by our authors of the book and also myself. Also, students who attend at least one of the elements classes can take advantage of a free 30-minute consultation with one of our How Money Works experts. And so they're also trained to help you chart a course to financial independence using our 7 money milestones methodology. Ooh, I like that. Now, your income creates your wealth. This is why the second of the 7 money milestones after boosting your financial education should be to protect your income. So now we're going to get started with this particular workshop. So we're talking about protection today. So we're starting this class with proper protection, milestone number 2, for a very important reason. So you need to protect yourself and your family from possible future loss of income or savings before you chart the rest of your journey. So if you were to die prematurely, your family could be left without your income, in addition to being without you. Now, your current savings might not be enough to take care of them at all. So we want to make sure that we've got proper protection in place. So though protecting yourself is more important than protecting your property, as Paul Payne put it, you might not be able to fully protect yourself from illness or accidents, but you can protect your income and your wealth. Now, ironically, protection of your financial assets is called life insurance. It's a defensive strategy motivated by a sense of love, responsibility, and sometimes even both. Now, you may ask the question, well, how much life insurance should I have? And the answer is that it's different for everyone. So based on your situation, however, as a rule of thumb, we recommend you consider having life insurance coverage that is at least 10 times your annual income, your family income. So as an example, if you earn $500,000 a year, you should consider $500,000 in coverage. Now that's a conservative, or at a conservative 5% rate of return, that would replace half of your income. So 10 times your income, if you make $50,000, you would want to have about $500,000 in protection. For a more specific calculation of your family needs, you want to ask your financial professional. Together, you can consider factors like your age, how much debt you have, your health, the number of dependents that you are responsible for, your role in your business, and your overall financial situation. So it's going to differ for everyone. So many people like Dana here didn't know 10 times your income was just a starting point for protecting your income. Sounds expensive, but you need to take a closer look into it before you decide you can't do it. So you may be pleasantly surprised. And who doesn't like surprises, right? So the same people who underestimate how much life insurance they need have a tendency to overestimate how much it will cost. So both assumptions can keep families from putting proper protection in place. As Insure.com says, only 59% of Americans have life insurance. And about half of those are underinsured, meaning they don't have enough life insurance. So you and your financial professional should cover your short-term and your long-term debts and other outstanding loans that you may have, but then also your financial goals, your mortgage or your rent payments, how old your children are, and how much their education could cost. So you want to take all those things into consideration, and we call that the DIME method. So it's debt, D for debt, I for income, M for mortgage, and E for education, potentially. So again, it's going to differ for everyone. So just with so many things, life insurance, with all the options out there, it does seem complex at first. But once you know a little, it becomes far simpler. So to start, it's important to understand that all life insurance usually falls into two basic categories of temporary and permanent. That's the only other, that's it. There's temporary and there's permanent, and we'll break down the different types. So let's look at term insurance, which provides coverage for a specific period of time, like 10 years, 20 years, or 30 years. Now, it's the most affordable life insurance available because it provides one core feature, and that is the death benefit. So this is the money that is paid to the beneficiary when the insured dies. And also because it expires after a term. That's why it's called term insurance. It's like when you rent an apartment or a house, when your lease is up, your lease is up. With term insurance, when that term is up, your insurance coverage is up. So with term life insurance, it is possible to have financial protection for your family or business with a relatively small monthly payment. So this can make it a fit for anyone with a limited budget during times of highest financial responsibility, like raising your children or paying off things like your mortgage or college or even running a company. That's if you're a business owner. But what happens when the term on your insurance ends? So there are two basic scenarios to look at. So scenario number one is that if you don't need coverage anymore, you can simply let your policy end. That's just what it does. So there's no fuss, there's no muss. You don't need it anymore. It's over. However, but what if after your term you still need coverage because you're still paying for your home, or you're a single income couple, or maybe you're supporting grown children or grandchildren, or you're still running your business or your company? So for these reasons and others, you might consider scenario number two, and that would be keeping the life insurance. Now, if you're in good health or your term policy has guaranteed insurability, you might be able to renew your old policy. But you have to remember, if you want a completely new term policy, you have to qualify medically again. If you can't qualify, a new term policy might not be the option for you. If you do qualify, the new policy will cost more because of your age. You've gotten older. So whether you're 10 years older, 20 years older, or 30 years older, you are older now. So for that being one of the reasons why it's going to cost you more. So the more expensive new term policy would be the best option for you in that situation. So the more expensive, so the older you are, the more expensive the new term insurance will be. So this is what we call the financial X wave. So it kind of makes an X. So in your younger years, represented in the blue on the left, you typically have more responsibility and less accumulated wealth. In your later years, the yellow side, the plan is for your accumulated wealth to increase as your responsibilities hopefully will be decreasing becoming less and less. So term insurance is typically most useful when your responsibilities are higher and your wealth is lower. So if these two factors flip later in life as planned, term insurance becomes less practical. But this, again, is a scenario that you have to, you and your financial professional can take a look at how the X-Wave can be applied to your particular situation, because, again, everybody's situation is different. So now let's take a look at permanent life insurance. So like term, it provides a death benefit to protect your family financially. However, permanent insurance is designed to keep and protect you for your entire life, not just for a particular period of time like term. So think about permanent life insurance as a lifelong strategy that can protect your family today, secure your wealth in the future, but then also provide for your family after you are gone. So once you're gone, that permanent life insurance should be able to take care of your family for, remember we talked about the 10 times your income for a minimum of at least 10 years, but it has the potential of being even more. And so we'll get into that as well. So there are 3 important benefits to permanent life insurance. So number 1, life insurance protection for your entire life. That's number 1. Number 2, with many permanent life policies, you can add long-term care as an optional rider, which we'll talk about that as well. And number 3 is your accumulated cash value, which can give you flexibility with the premiums, which means, if you ever can't pay your premiums for some reason, they can be paid out of the cash value within your policy. So that's a great benefit. Some other benefits that can be included with a permanent life insurance strategy can be advantages like absolutely no market risk, long-term care coverage, tax-free growth, tax-free income, and a tax-free legacy. Avoiding taxes is extremely important to consider because it can directly affect and significantly affect how much money you'll live on in retirement and the amount you'll leave your heirs. I mean, I think we all want to pay less taxes as we get older, right? So it can be very important. Now we're going to talk about the cash value piece. So the cash value component of permanent insurance is and why it can be so important. So a portion of your monthly premium is set aside in an account that grows over the lifetime of the policy. So that money in that account is your cash accumulation. It can also be used to fund future purchases. So you see a few examples here on the screen. So in addition to no market risk and also tax-free growth, tax-free income, and tax-free legacy, as we just mentioned, life insurance cash value can also be creditor proof, which means creditors cannot come after you. Ooh, that's nice. So creditors cannot come after you, talking about the beneficiaries, because it's creditor proof, right? So when you look at them all together, the advantages of the cash value benefit are extremely powerful. Let me drink my water real quick. Now, we saw that long-term care can be added to a permanent life insurance policy as what we call a rider. So let's talk about the importance of long-term care insurance for a moment. So you may or you may not know this, but 70% of people age 65 or older will need some type of life insurance care services and support at some point in their lifetime. So in other words, statistically, it's likely that you and I will need it. That's just where the numbers are. But here's the thing. Only 8% of people over age 55 have purchased long-term care insurance coverage. So that sounds like a possible problem and an expensive one that's just waiting to happen. So long-term care insurance coverage helps cover out-of-pocket expenses that can really add up actually really quickly. It can be used to pay for qualified services like nursing home care, home health care, assisted living care, and also adult daycare. And you never know if or when you might need it, because things happen all the time and they're always unexpected. So it's always nice to plan for those unexpected things to happen. You don't know when, you don't know if, but you'll be prepared with long-term care. So the average long-term care needed, and if you look on the screen there, if more than 1 year lasts about just under 4 years, 3.9 years, so 3 years and 9 months. But as you can see, the average total cost can be a crippling expense if not covered by your policy. So costs without long-term coverage could very easily can drain one or more savings assets you were counting on for the future, right? Could wipe out your retirement account, could wipe out a college fund very, very quickly if those are the assets that you have, right? So there are a couple long-term care options that you can take a look at. So the first is the traditional, which is called standalone. It's a standalone policy. So even if you don't have life insurance, you can go directly to an insurance company to purchase a standalone long-term care policy. Or you can opt to add a rider to your permanent life insurance policy. So if it's available on your permanent life insurance policy, some it may not be available because they're just not designed that way. You can add long-term care protection to the policy in the form of a rider for an extra cost. Everyone should look into this option because, as the stats show, 70% of people who are 55 or older at some point are going to need long-term care or long-term care services. So it's likely that you and me, somebody that you know, someone that you work with, your parents, brother, sister, are going to need long-term care. So if you go with option one and buy a traditional standalone policy, there are a few things that you should know. So like the fact that premiums start low, but insurance companies can raise rates on them. Also, you usually pay for care up front out of your pocket, which can be a big inconvenience. Then you get reimbursed, which can seem as an inconvenience during a very difficult time. That's the last thing you want to think about is getting all your receipts together, submitting the paperwork, and then waiting on the insurance company to reimburse you. Another thing to keep in mind with standalone is, you can spend $1,000. You can spend thousands on premiums and get nothing back in return. Although there's a 70% chance that you'll need it, there's also a 30% chance that you won't because you just never know. Now, second option is you choose to add a long-term care rider to a permanent life insurance policy. One of the key advantages of this option is that life insurance companies typically don't raise the rates for life insurance policy holders. So some insurance companies, after a waiting period, pay you money to cover your long-term expenses, which you can spend however you see fit. Again, so with this option, there's no need to submit receipts once the eligibility requirements have been met. So coupling your life and your long-term care protection can equal a big savings. So putting those two things together, so your permanent life insurance and then adding long-term protection could equal some very big savings. So if you're one of the lucky 30% who end up not needing long-term care, your premiums aren't wasted. Instead, your family receives a larger tax-free death benefit. Now, that's what I meant by, it could be a bigger advantage because that death benefit becomes larger because of the premiums that you use for the long-term care also have an opportunity to grow as well, just like your cash accumulation or your cash value. So long-term care riders aren't the only riders available. You can also consider other living benefits like critical and chronic illness riders that can help save the day if you face any of the death challenges like you see on the screen. So you definitely want to discuss adding these riders to your permanent policies if you have one. If you don't, talk to your financial professional, talk to me, one of our other How Money Works educators, and we can help you with that. But some are inexpensive or even cost nothing extra to add. So you definitely want to make sure that you are in the know as it pertains to long-term care and riders and how they can be added if they're not already in the policy itself. Now, as I mentioned before, our mission is to reach 20 million families, or to teach, reach and teach 20 million families how money works within the next decade. We're going to stamp out financial illiteracy in every community. It's a huge undertaking. That's why it will require an army, and we say army because, the military, there's a lot of them, but thousands of How Money Works educators. So we're always looking for people to help us teach these classes. That's where you or someone you know can come in and help out. You can be a part of our mission, a part of our campaign to stamp out financial illiteracy. So we're at the end of today's element. So think about, again, as we go through these classes, think about the concepts that resonate with you the most. And that's why we started on a mission of eradicating financial illiteracy. This is how you start to take control of your finances. We call it the money discovery. So at the back of the book, these 2 pages are where you start to put pen to paper and start writing your numbers down. So part of attending this course is we can help you if you don't have a financial professional yet. So again, this works like, again, you think about when you're going, so when you go to your Google Maps, for directions, there's 2 entry points or 2 points of reference. That's all you need. It's the same thing with becoming financially free. You need to know where you are today and then where you want to be in the future. And once you know that, we can help you create your financial roadmap. So the How Money Works Money Discovery is in the book. It could help you take care of that. So think about where you are today and where you want to be 5, 10, 15, 20 years from now. Get this education, coupled with a financial educator like myself. We can help you put together that financial roadmap and help you become financially free. So I am glad that I've had the opportunity to work with you guys thus far. So our How Money experts are available to sit down with you now that you've attended one of our Elements classes. But the question is, how do these concepts work for your financials and your personal numbers? And how much faster will you be able to complete the 7 money milestones when you have an expert guiding you? So your discussion will be private, short, and focused, exclusively on your financial goals. So if you're interested, our experts can crunch the numbers, make recommendations, and give you access. And that's the most important thing is you get this education, but then you have access to the best products and services available in the market. So if you're interested at this point, you text me right after the class. I'll let you start by putting your money to work today, and we'll get at this thing. I'm excited. I hope you guys are excited too. So if you like what you learned today and you would like more, you can follow How Money Works on Instagram at How Money Works Official for more practical tips and also helpful resources. So today is Monday. We will see you next time, which will be next Monday. And I'm not sure which one is next. I think it's short term, but I'll be sending out that email very, very shortly as well. You guys have a great day. Thanks.